Morning, folks. Welcome back to our 3 times weekly stream, Monday, Wednesday, Friday, here at Guardia. And without further ado, if you guys have seen the agenda in the Discord, we will jump right on in. And so what we're going to talk about today are 3 things that kind of caught my eye between kind of the news cycle, where we're at with markets, middle of the year, a lot of asset managers starting to report kind of their mid-year findings, quarter-end findings, what their outlook is for the rest of the year. And, in having some conversations with you guys, it seems to be that sentiments are fairly high when we think about U.S. equities, in particular, U.S. stocks. But what kind of is the shadow on top of that positive outlook is what we continue to see in the credit market and in the debt markets, not just in the U.S., but globally, right? So the last time we talked about this on Monday a little bit, the last time we saw a central bank in the U.S. really take action to fight inflation, to help, the economy, but also sort of the consumers, the citizens, the workers of the economy. Remember that the U.S., actually the majority of employees in the United States work for small businesses. Take that one home. I mean, when I actually dug into the macro data and found that out, a few years ago, I was like, get out of here. So most people work for companies with 10 to 20 employees. Really impressive. And it also sort of goes to show, who absorbs most of the pain when central banks take these active positions, right? And they start playing around with what the costs of mortgages are, what the cost of lending is. And the last time we saw this was in the 80s with Paul Volcker, who raised interest rates 20% in an extremely short term. We haven't seen that since, and now we're seeing it. And I have to say, I'm surprised not more things broke. The main thing that broke, in my opinion, were these regional banks that were kind of playing a little bit of roulette with their risk profile. Look at Silicon Valley Bank, look at First Republic. There's a slew of more. There's crypto banks that kind of fell for the same thing. And so that's when I started to get nervous. Interest rates around 5%. Those regional banks that were playing a funny game ended up getting wiped out. That was the first break. If we were on a submarine, I'd be like, okay, there's some noise that's not okay. And typically the consequences of that noise are destruction, capital destruction. People lose savings, lose jobs, lose businesses. And it was properly kind of plugged by the facilities that the Fed, the Treasury, all of the sort of governing bodies that touch money in the economy, had worked together post 2008, put together some of these funds precisely to combat crises like the one that we saw earlier this year. So really positive. And with that, I'll jump into real estate again, right? This morning I saw some headlines coming through the Bloomberg on whether Goldman is sort of taking a hit on real estate deal making slump. So there's less deals that Goldman is advising on in the investment banking space. The real estate portfolio is taking a hit. This has been something we've been seeing for a long time. On the sentiment check side, I'm starting to see in social media some skits and TikToks about how, I'm the only person that comes into the office 5 days a week. It paired along with, I believe, the Wall Street Journal publishing about how most banks are now going to start asking employees to come back 5 days a week. And so we're starting to see in the media sphere that sentiment unravel. But what we're really seeing is, on kind of the mass scale, which I'll say social media, Instagram videos, TikToks, Reels, YouTube Shorts, we're seeing actually a lot of humor surrounding how empty commercial real estate is. And, especially over the last 5 years, I've come to take a lot of these kind of humoristic cycles, especially if they touch office culture, if they touch current events in the financial press, that they actually say quite a bit, especially when we start to see that, the video or the meme is really proliferating. And what it tells us is that we're still having what I called a couple of years ago when this started, the intergenerational war of work from home war, where kind of legacy and leadership at large firms want everyone in the office. They want to retain the real estate holdings or structures of their businesses. Young people are saying, why would I waste an extra 2 to 4 hours a day commuting to work when I can be more productive from home and, to a certain degree more comfortable? I've been always, kind of opinion only that I think a hybrid process works best. I think it's important to rub shoulders with the team, swap ideas, and get more sensory data than just information and occasionally video and audio. Not to say that, we want to be hands-on, but I think it's good just mentally mix it up, be close to people, get some oxytocin from being, near, work colleagues that you like, or maybe if you don't like your work colleagues, it's a separate problem. But interesting to see Goldman Sachs's, earnings. Earnings fell 58% on investment banking slump, real estate markdowns, and goodwill write-down in the consumer business also struggled. Their consumer lending business not doing great. And, these are the kinds of things that the Fed wants to see, basically, when they raise interest rates. They want to see less deals, lower economic activity, people borrowing less. They want to see everyone tone it down so that the supply side, in this case Goldman Sachs or the bank who sells the service, will tone down their prices, will increase their value proposition, that sort of thing. And so going back to the real estate story, or it's really all one story, that's the point I'm trying to make, is that, with the concerns about commercial real estate, right? Oh, people aren't using office space, people aren't going to the office, companies are looking to cut costs in some way. This is a very real concern, but it's based on kind of consumer and business behavior. Now, what's behind all of that? Because what's the number one financial product? At least I've said this before in our series. What is one of the most popular financial products in the American economy? The answer is mortgage, right? I'd say credit cards and mortgages are the top products. But mortgage is the product that the entire financial system was sort of built upon. They are sort of high amount loans. You can take them out for a small commitment of capital, and you can then buy a hard asset that's not super liquid but is highly leveraged, right? A business is not going to run around buying massive corporate properties in cash, especially in their early years, unless you're associated with SoftBank or I can't pronounce his name, Mayatoshi-san or Mayasoshi. It's not that I can't pronounce it, I just don't know it, the exact spelling. I can look it up in a second. But the banks are behind the real estate. So if the consumer behavior changes, if the business decision maker behavior changes, there's underlying debt behind these properties. There are long-term leases that are exorbitant amounts, and leases will be broken. Mortgages may go unpaid or underpaid or refinanced, and that can create quite a stir crossing from the real estate market to the financial market, and could break things further. The interesting thing here is that most of this is controlled by sort of the largest banks in the U.S. We're seeing Goldman start to sort of buckle. It's not a great sign, but it's a continued kind of let's monitor to this, let's watch this. On the other hand, I was having a conversation with a real estate investor here in New York, and what the flip side of this equation is, if you're interested in real estate, it's a little bit of a wait and see moment, or extra high conviction moment. Because on one end, okay, we have elevated mortgage rates. I think above 7% in some cases. We see that inflation fell down last month aggressively, from 6% around there down to 3%. The Fed and investors in the bond market are saying the Fed's probably going to cut rates next year. They're going to bring the rates back down to keep the economy rolling. So what's going to happen? If the Fed lowers rates, I think especially residential real estate, we'll see a rally. Because everyone will be like, oh my gosh, cheap money is back. We have to buy houses now. Maybe rates will go back up above 3% again. So I don't want to miss my second chance to do this and buy properties. So I actually agree with that sentiment. I think for now rates are slated to continue to go up, if not pause. But if they go up, if they go down, we'll see an absolute ocean of demand for sort of blue chip residential real estate. I think so. We'll see an uptick in mortgages. So, to some extent, they made the point that, maybe right now is not the worst time to buy, and you simply buy with a heavy mortgage and then you refinance down the line, and your property value theoretically will increase. Now, if we live in a world where these rates remain for the next 5 years, that's a different story. I think we'll just see an overall kind of repricing in real estate, and again, residential versus commercial, two very different things. Residential, of course, being more diversified, people buy more residences than they do business spaces, but something definitely to watch very, very closely, and watch the relationships between the large banks that underwrite some of this commercial real estate. Now, the other thing, I think I went a little too long on that one, but the next thing I wanted to talk about was ETFs with a loss buffer. Something I read about this morning, and I need to sit down and read the filings of these ETFs. But my takeaway is that TJUL, TJUL, is an ETF that tracks S&P returns, but with 100% buffer. The fund will cap upside returns over a 2-year time frame. They continue to invent really insane financial products, and the old rule that it says in the old extra old black book is that when someone offers you 100% downside protection or a guarantee behind your investment, it's oftentimes a Ponzi scheme, some sort of fraud, or a product that's going to break and not work, because that's just simply not how investing works. But investors in the 7.5 trillion ETF universe can now put money behind the equity defined protection, which began trading under TJUL yesterday. It comes from Innovator Capital Management. They launched the first so-called buffer ETF, also sometimes referred to as defined outcome funds, in 2018. So this isn't new, but they're starting to they're getting into stride with the marketing and the design. They buffer exposure to stocks by limiting downside risk while capping upside potential. It's funny because the other video I made the other day was to think about, I might have not published this, but I made a video to think about variable income as if you were the nation of Chile, who's the top copper producer of the world. And what Chile does is that when things are going gangbusters in the copper market, prices are high, demand is high, they put away a percentage of those returns, those excess returns, and they put it in a fund to buoy the copper industry and the market locally when there's a correction, or when copper prices crash or go down, as commodities have the historical tendency to do. In this case, they're trying to use a similar principle with the S&P. So it seems like when the S&P crosses some sort of return threshold, they put that into the fund for loss protection. I find it really interesting. I'm going to dig in. I'm going to look at the filing. Maybe we'll pull it up and look at it together, so we can go through that exercise of how do we understand financial products, especially in equities, which is a little bit of the Wild West and a little less fleshed out. But really interesting stuff. That's, love to keep new products and things on the radar for you guys. So that's that. And last but not least, also ties into kind of the banks, loans, real estate conversation, is Carvana. So Carvana's stock went up 40-something% after market. I think it's still up almost 30% right now, right before the market opens. But Carvana is if you didn't see the commercials during pandemic, it is a car vending machine. They've tried to make the car purchase and delivery process seamless, like ordering something off of Amazon, and they show up to your home and drop off the car. Kind of an amazing business. Their stock went through the roof during the pandemic because of used car demand. Used car demand was insane, and Carvana was a direct beneficiary of that demand. However, the stock has been a massive roller coaster ride in volatility. As it's gone up and down. It seems that their capital structure wasn't working. They weren't able to really grow or create profitability unless the market was just completely flooding in their direction. So they announced a deal to restructure a lot of their debt and sell 1 billion of additional shares. So they're trying to regain their footing, and the market likes it. The market likes to see companies that have made mistakes take massive strides to fix things. This is kind of what they would call a restructuring play. You find an ugly duckling in a segment that has some, what they call in the industry like secular tailwinds or macro tailwinds. There's broader trends that are blowing this company in the right direction, even if the company is doing everything wrong. And so, especially if you are able to find a business that's doing that. So, if you find a semiconductor company that has great assets or maybe a great past, but has made some mistakes in the near term, bad CEO, bad capital structure, too much debt, etc., it's actually always an interesting case to dig in and see if there is actually potential for the company to really convince the public of a turnaround and some great new near-term plans. So that's what Carvana did. Technically, it's a default, right? It's kind of a selective default. They're deciding that they can't pay the debt that they have right now. So what they decided this agreement with bondholders will eliminate 83% of Carvana's 2025 and 2027 unsecured notes, which are debt they have sold to the market to pay off by then. So they're canceling most of that debt, and they have lower cash interest expenses by $430 million. The deal is supported by Apollo, which is notorious for kind of getting involved in these kinds of things. And they're planning to sell 35 million additional shares of the stock, and they expect at least 350 million in proceeds from that sale. So they're looking to cut their debt by 1.2 billion. They're issuing stock to raise more money to keep building the balance sheet. It's a compelling restructuring play. To get in when the stock's up 48% after a day, I think it's up to you if you want to go in and dig through and you think that that's just the drop in the bucket in terms of what Carvana can work its way back up to, especially as it restructures. But we've slightly missed the boat here. I mean, and these types of ideas and plays require like fairly sophisticated investors, right, who spend all their time finding these ugly ducklings and then sort of crunching their financial data to see what's the magic ingredient that they need to become one of those businesses that pops throughout the course of a restructuring. And they're also dangerous. I mean, we could go a month from now and there could be something that was reneged on that deal, or a bondholder, maybe a hedge fund that says, I don't agree with this, and then this could really take wind out of the sails. But I thought it was a good case to share with you guys so you can get a little flavor of what kind of a restructuring, an ugly duckling kind of turnaround opportunity looks like. But without further ado, that's all I have for today. So, crazy new ETFs, Carvana trying to pull off a turnaround, and we're worried about real estate and the banking convergence here, especially in terms of commercial real estate. All right, guys, we'll catch up on Friday. Take care.